Welcome to Whiteboard Fridays. I'm Jeff, and it's a new week, a new shirt, and a new topic. So a lot of you are asking, what's the difference between a comprehensive capital income tax that we were talking about last week and a capital gains tax? And that's what we'll be looking at today. And we'll also look at 3 reasons why we think a comprehensive capital income tax is better than the capital gains tax put forward by the Labour and Greens in the last election. So, before we start, a quick recap. Remember, the problem is that we don't tax the income from all capital in New Zealand evenly. And that's a $7 billion hole in our tax system. So if you are paying PAYE, you're paying too much tax. Let's look at the difference between these two things, see how they actually work in practice. So a capital gains tax, you pay tax on the income, on the increase in the value of an asset that you get. So imagine that you bought an asset, a house, a farm, or a business for $100, and then you sold it for $200, okay? Now, a few things we can notice straight away. We have to keep track of how much we bought the asset for, as well as how much we sell it for. So that is more complex, less simple, okay? Now, we pay tax on that, on the increase in the value of that asset. So that's $100. And that happens at sale, okay? So another reason why a capital gains tax is less good than a comprehensive capital income tax is because it gives you an incentive not to sell things. And that's bad for growing businesses. Sometimes they need to be sold. And finally, we take a look at the increase in income and we tax that at, the Labour proposal was 15%, so the government would get $15 when you sell that asset, okay, $15 in tax. Now, a couple of things about that. You're only getting that when that asset has been sold, so it's a less reliable source of revenue. Also, you only get the tax if the price of that asset increases. Now, if the price of that asset falls, the tax department will end up having to give this taxpayer a rebate. So another reason why capital gains taxes are less reliable sources of revenue. Sometimes they can cost the government money. Now let's look at how a capital income tax would work. Okay? So we don't need to know what you bought the asset for, we just need to know the current value of that asset, which we know is $200. So, straight away, it's more simple, less paperwork, less things to keep track of. So we've got an asset that's worth $200, and what we have to work out is what is the effective income that people are getting from that asset. Well, if you're already getting income from that asset and paying tax on it, then there's no extra tax to pay. So that's a good incentive to invest in things that are productive, assets that are productive. If you're not paying any return on that, any income, if you're not paying any tax on the income from that asset at the moment, then you will have some tax to pay under this tax. And how we work that out, as we say, is what would happen if you had that $200 in the bank? Well, you'd be getting 5% interest, okay? So that's worth $10 to you a year. Now, if you're not getting $10 in interest a year, you must be getting other benefits from that asset that you're not paying tax on right now. Why don't you sell that asset and put the money in the bank? You must be getting some sort of other benefits from that asset, whether it's a house, a business, or a lifestyle business in particular. So what we do is we then apply a tax rate to that $10. We assume that's the income that you're going to be getting this year, and we tax that at 25%. It's a lower rate than we tax things now, because if we taxed capital properly, we'd be able to drop all tax rates. So that would work out at about $2.50 in tax. Now that's paid annually, paid every year, as if you're receiving that $10 of income every year. So we see right away that a capital income tax is a more reliable source of revenue for the government. It's more simple for the tax department to calculate, more reliable source of revenue, and it gives the right incentives to invest money in productive assets, stuff that is going to actually generate a return. Because remember, if you're already getting income from that asset and it's more than that 5% amount that you get from a bank, then there's no extra tax to pay. That, folks, is the difference between a capital gains tax and a capital income tax. One last thing to remember. The proposal put forward by the Labor and the Greens for a capital gains tax, that had exemptions in it on the family home. That makes things even less simple and even less reliable. More exemptions mean more ways for people who can afford accountants to find loopholes in the tax system, and that's what we're trying to avoid. So, that was another Whiteboard Friday. Thanks for tuning in. Any comments greatly received? Is the shirt an improvement? I hope so. It's a little bit red, good for the Labor fans out there.